morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Devina Khanna.
Good morning, Devina. Good morning, viewers. I'm Darshan Mehta and I'm standing in for Neeraj Shah, who is at the JPMorgan conference. We are watching Indian Open. Let's go straight to the headlines. The market regulator approves changes to FPI ownership norms, also allows a wider purview of the consent mechanism and cuts expenses paid by mutual fund investors.
Foreign entities can now invest in non-sensitive commodity derivatives.
Banks are unwilling to lend to road developers, says Union Minister for Road Transport and Highways Nitin Gadkari, urges lenders to support players.
Telecom price war is far from over, says Kumar Mangalam Birla, the chairman of the newly merged Vodafone Idea Combined.
And China imposes higher tariffs on US goods worth $60 billion in retaliation to Trump's decision to hike import duty on Chinese products. Okay, let's take a look at the trade setup for today. The global markets did well. If you're looking at most of the US markets, they ended up anywhere above higher by almost 0.5% to close to 0.7%. So the close was decent. Europe did well. Asia, most of the markets have managed to open with a positive bias. Now, let's take a look at the SGX Nifty, which will give an indication of what we're doing. It's come up significantly from the lows of the day. It's up 20 points, but still remember there's an hour to go for trade. So that could change anytime as per the Asian markets. Important to note, today is the weekly expiry for the Bank Nifty because tomorrow is a holiday. So it will be very important to see how the Nifty Bank and the Nifty PSU Bank, both of them move in trade. And for the past few days, there have been serious weakness. If you look at this week itself, the Nifty Bank is down in the past two trading session, down close to Nifty PSU Bank is down 7%. The Nifty is down over 2.5%. So there is weakness that is seen. As far as the FNOQs are concerned, there is the trade setup that we're seeing is indicating weakness on the indices on the Nifty. The maximum open interest on the call side has shifted to 11,500, which now says that 11,500 will be the big resistance that the market is looking at, and the puts have shifted to 11,200. So there is still potential for the markets to go down even further. Now look at where open interest concentration is. The 11,400 put, 11,500 put, and the 11,600 put. They have anywhere between 20 to 33 lakh shares open interest build up that is there, and the Nifty is trading below the 11,400 mark in trade. So if the Nifty trades below this level, all these positions will be unwound because the premiums will actually go up significantly and there will be more selling pressure that will be seen. So the trade setup currently as for the FNO looks rather weak. As far as the sectors are concerned, all the sectors traded with a negative bias in the last three trading session. Look at the cuts that have come in on the PSU Bank Index, which is down 7%. Nifty Bank is down 3%. Auto Index is down 2.5%. Certain things I want to watch out for. Watch out for both HDFC, AMC and Reliance Nippon. Because of the changes in the TER that the SEBI has put out, there have been target price cuts and downgrades coming in on both the companies, so they will react negatively. MCX will probably react positively as SEBI says they have taken the first step to open commodity derivative market for foreign investors. And Sun Pharma announced that their European partner received the approval for Tildra. It's a big drug for them, so should probably react positively. Some brokerage reports, IDFC has initiated on Dr. Lal with a target price of 1184, and so there is substantial upside. And Nomura has initiated on JSW Steel with a target price of 484. And in terms of brokerages, Goldman Sachs has upgraded Shriram Transport to a buy after the big fall that we saw. The target price is 1491, so they believe there is potential upside still left in the counter. Okay, so that's what we're seeing at. Okay. So Neeraj is at the JPMorgan conference. We'll cut across to him at the conference. He's in conversation with Filippo Gori, Head of Sales and Marketing for Markets and Investor Service at JPMorgan Asia Pacific. Neeraj, over to you.
Thanks a lot for that, Darshan, and good morning to all the viewers. Yes, we are live from the JPMorgan India Investor Summit 2018, and boy, the preparations are set. 2 days, or in fact, presented to you over 3 days on Bloomberg Quint, 200 investors, about 80 odd companies, a bevy of ministers, and the JPMorgan think tank to kickstart the conversations on Bloomberg Quint. As you said, Darshan, Filippo Gori, Head of Sales and Marketing for Markets and Investor Services at JPMorgan Asia Pacific, with me on the show. Filippo, good morning and thank you so much for being here.
Thank you for having me.
Pleasure. So what's the central message that you guys hope to drive home via this conference? Because it's happening right at the fulcrum of what is on everybody's mind, which is the trade war, which is right now center stage, and the fact that the dollar, US dollar, is trending in a meaningful way versus the EM currencies. Those are arguably the two most talked points. Add to that crude and Saudi Arabia being comfortable northwards of 80, and you have a potent cocktail.
So I think it's a pivotal time for us to have the conference here in Delhi. I think it reinforces our view that India as a country is an important country for our investors and for the globe in general. It's a country that can sustain better than others also possibly some of the falls from the trade war. And in general, we remain super positive on the country given the demographics and the technology and the digitalization that is happening. And therefore, the high attendance that we're having this year again, I think it's an indication of how global investors are looking again positively at India.
Are you guys in fact taking out that message? Because back home, when we speak to domestic investors who are getting a clutch of money to invest into, they are all citing one issue, and that is, or rather two issues. One is the valuations, and boy, India has had a good year thus far, and the twin deficits that might threaten or derail the party.
So on the valuations, we remain positive. We still think that in 2019, the overall earnings will grow for India at around 15%, which is still a very good number that should be attractive for investors. We believe that the monetization and the impact of GST that was in people's mind in the past few years is probably fading away, and therefore we still believe that is attractive from an investment point of view. Clearly, the currency is something that is on the back of people's mind. India has fared better than most of the current account deficit EM countries, probably until August. In August, they suffered a 5% drop in the currency, which it was kind of expected. And where we go from here, I think it's on the back of people's mind. I think investors could be concerned because next year is election year, so they will be watching out for profligacy from a fiscal standpoint, and therefore our message is probably that fiscal orthodoxy is probably what is required to keep investors interested in India in the foreseeable future.
Interesting. Filippo, how does India do when the world is doing what it is doing, and the US economy is doing rather well?
Exactly.
Europe, well, neither here nor there, so to say, if I can quote the Bill Bryson book. So what happens in such a global scenario? Because 2017 was all about the global GDP growth moving up in a coordinated fashion. 2018 has been anything but that. It's
the coupling. It's the history. It's the story of the coupling. US is growing. The rate cycle is, in our opinion, is set to stay. We believe there are going to be other 2 hikes between now and year end. By the way, we have the same view for India. Europe is dealing with a problem on the periphery. Southern Europe, my country of origin, Italy, for instance, is going through tough times. Brexit is a known unknown. It's known that it's going to happen, but is unknown in the level of the quantum of what we will be facing. And EM in general, you have the current account deficit countries that are suffering as you would have expected in a raising rate scenario, and the trade war. So these are, I think, are some of the topics on the back of people's mind. And on the trade war, we feel it's a kind of lose-lose for both parties involved.
China has retaliated as well, as we know.
As expected.
So how big a problem could it be for world markets?
I think at this point in time, if you look at even at the indices overnight after the announcement, that they didn't really suffer that much. I think it's on the back of people's mind is either it's incredible optimism or there's the belief that some sort of agreement will be reached. Some of these retaliatory measures are only kick-starting next year, so there is time to find an agreement. But we are getting closer to some sort of cliff edge scenario. So far, the amount of our estimate of the amount of US measures against China will have an impact on GDP, but so far we think it's something like 0.7% of GDP. It's not dramatic, but it is.
All right, Filippo, Gori, they're talking with Neeraj about various issues that could probably plague India and what's been happening on the world front. But let's talk a little bit more on what's lined up for you on First Word. Paci takes us to the big decisions taken by the SEBI board. And Jayesh will join us later to tell us how the total expense ratio will impact mutual fund earnings. Next up, cement companies don't really paint a very pretty picture for this year, with almost all their annual reports listing out challenges, at least in their annual reports. Nikki fills us in on that. And finally, Agam does an analysis of why Hexaware is an outlier for this year.
Okay, let's start with First Word. The big important story was SEBI. The SEBI board had a lot on its plate on Tuesday. The market regulator has decided to accept most of the recommendations made by individual committees appointed to look into issues like FPI ownership, the consent mechanism, and lower total expense ratio for mutual fund. Let's first get in Paci Upadhyay to take us through all the big decisions that were taken. Paci, over to you.
Well, let me take you through the top 5 key highlights of the SEBI board meet on Tuesday. The first one is in the context of the infamous April 10 circular, in the context of foreign portfolio investments and the KYC requirements. Now, remember, the HR Khan committee had recommended several, changes to that April 10 circular. Those have been largely accepted by SEBI, but what specifically those changes are, we'll have to wait for the final circular. But what the SEBI chairman indicated is that the beneficial owner concept that was brought in the April 10 circular will be applicable only for KYC requirements and not as to the restrictions on the ability to invest in the Indian market by FPIs or NRIs. But yet we have to wait for the final circular on this one. The second important decision that SEBI has taken is to reduce the time period for listing of issues from the current T+6 days to T+3 days. Broadly, this was an ask by market participants. SEBI has also said that the UPI or the Unified Payment Interface will also be used in this process. How that process will work is yet to be announced by SEBI. The third important change has to do with the changes to SEBI's prevention of fraudulent and unfair trade practices regulations. In here, SEBI has expanded the scope of its regulations to include employees and agents of employees. These individuals currently in the existing definition were arguably out of the purview of the regulations. SEBI has also strengthened the definition of fraud to include activities such as misleading information on digital media, and some of the experts we spoke with said that this is to target exchange of information on listed equities on platforms like WhatsApp by people who may not necessarily be market intermediaries, but play an important role in the market. SEBI has also amended its prevention of insider trading regulations to include who unpublished price-sensitive information can be shared with for legitimate purposes. Currently, this legitimate purpose was not defined under the definition, and the press release indicates a due diligence kind of situation as a scenario where such sharing of UPSI may be merited. They've also indicated that there are going to be additional defenses when trading in possession of UPSI, and the companies will need to lay down a code of conduct and internal controls when they share their UPSI. Again, details on those will be forthcoming once we have the final regulations with us. The fourth change SEBI has made is to its delisting regulations. Currently, the price that was arrived at through the reverse book building process was the final price. SEBI has now said if the promoters don't like that price, they can give a counter offer to all the shareholders. The final change that SEBI has made is consent mechanism. The committee had recommended that egregious violations like insider trading or fraud or front running may also be included in the consent framework, which currently aren't. But SEBI has said that any alleged default that has that causes a huge market-wide impact or affects the integrity of the market, those are, and that will be the yardstick that will be used to assess whether an offence is consentable or not. Again, the details of that will be clear once SEBI publishes its final regulations. Back to you.
All right, that's Paci highlighting all the crucial decisions taken by the SEBI yesterday. Another crucial decision, however, which will impact markets and AMC companies particularly listed, is that they have capped or lowered the expenses paid by investors of equity mutual fund schemes. The expense ratio has been linked to assets under management of the AUM, and different tiers, the expense ratio has been lowered. And what is the impact of this, particularly on the financials of AMCs, and how the tier breakup happens? Jayesh Khilnani is standing by to tell us all that's there and the impact of that. Jayesh, considering that just recently in the past, this year itself, they had lowered expenses by about 15 basis points. They've come out with another one. The market was expecting this, but the quantum and the timing of it.
That's right. In fact, the market was, in fact, anticipating, and there's some changes that have come about. First, let's have a look at what are the changes that, or how it's going to likely impact the basis points that we are looking at. So what you have is the various categories. So, they have divided into AUM from 0 to 500 and so on and so forth. So these are the newly imposed total expense ratios that have been defined right now. But what we actually did was by using the Bloomberg terminal, we got what is the average TER for each of these categories, and there is significant reduction that some of the categories will have to go through. In all of my conversations with the experts, what they are of the belief is that any scheme which has an AUM less than 2,200 crores, that will have a minor impact, whereas the major impact will come about for the larger schemes in excess of 2,200 crores, especially the ones in the 5,000 to 10,000 crore bracket and the 10,000 to 50,000 crores. So that's how the total expense ratio looks like. But what's going to be the impact on this on the industry itself, if we can have that one? So the biggest thing that everyone is talking about, that this will now create a level playing field. There will be no differentiation between a larger AMC and a smaller AMC in terms of the performance that they will have to deliver. Of course, it will result in a revenue reduction for the AMCs, and it will also bar the upfront distributor commissions that have been playing out. The point that is not mentioned over here, and a lot of people told me offline, was that this will actually result in selling of other products as well, because if the total expense ratio reduces, the revenue is likely to reduce. So there might be motivation to sell more of PMS products or AIF or other such revenue generating products that we have in the industry overall.
So Jayesh, a couple of follow-up questions. First of all, currently, how much is being charged? You gave an average about it. So is that the average that is there? Do you have a number of how charges? And the market will be keenly watching out, because there are two listed companies, RNAM, which I think Nomura downgraded today, and HDFC AMC, which has been falling significantly, and this comes as a negative, and a lot of brokerages have cut target price. So what's the impact on these two?
That's right, Darshan. Let's break it up into two parts. One is there's going to be an impact on the existing schemes that are there. Some of them are charging significantly higher expense ratios, so they will get impacted because they will have to lower down their expenses. And the other one is the the stock impact. So first, let's have a look at the expense ratio cut. Now, what you have is from the 0 to 500 crores. These are the top three schemes. So they have to revise this down to 2.25%, and you can see that all three of these schemes are in excess of 3%, so they will have to take a significant cut in terms of their expenses. Similarly, if we go to the next category of AUM, so from 500 to 750 crores, the SEBI has now mentioned about 2%, and these are the top three schemes that are charging their expenses in excess of 2.8%. So, once again, we'll see significant reduction over here. While making these, Darshan, what really stood out for me was some of the names that popped up from the SBI mutual fund house. So if you see that there's consistency of SBI topping the list, which means that SBI will have to take a a bigger hit as a fund house is concerned. So once again, we have the top scheme over here in this category as SBI small cap fund, which is 2.74%. They will have to revise this down to 1.75%. If we can go to the next category, you can see that 2 out of the top 3 are from the SBI stable. So 2.5% versus the 1.6% that has been proposed or that has been decided. So significant cut will likely come in over here as well. As far as the 5,000 to 10,000 crore AUM is concerned, they have to revise it to 1.5%. And you can see that these top 3 funds are actually charging about 2.3 to 2.4 odd percent. The next category also shows you the same thing. So SBI blue chip fund. So SBI is the one that really stands out, 2.4% that they will have to charge for these particular schemes. Now, the stock impact that you were talking about, there have been brokerages that are in fact downgrading the stock, and so we have one from Nomura which has downgraded Reliance Nippon. This was the first AMC to get listed in India, so there's potential downside of about 2%. They've downgraded it to neutral. What most of these brokerages are saying that earnings of this the entire sector are likely to get cut by about 20 to 25% on an FY19 and FY20 basis. We also have one from which is on HDFC AMC. The target price over there has been cut to about 1765 from 2050. So the stock first of all never went to 2000. It has been revised downwards, and the stock actually trades below where the target price is right now. So 20% that we have seen as a stock correction for HDFC AMC. What they are actually saying is that the potential upside now will be trimmed to about 15.5 some odd percent, and like I was telling you, the overall brokerage community, they are of the view that this will result in the sector earnings getting cut by about 13 to 15 odd percent. So scheme wise and stock wise looks negative for all of them.
So Jayesh, I saw a couple of, so SBI you pointed out, the other one was Birla
yes,
schemes.
That's right.
And a couple of Reliance mutual fund scheme. Any reason why their expense ratios is so much higher than the average? Because the average was lower and their was much higher, almost 100 basis points higher. Any reason why this is happening?
So Darshan, I spoke to a lot of people, though no one has confirmed why the expense ratio was higher, but the general observation is that the larger the AMC, the higher the expense ratio that they have. So Birla was one of them, and of course SBI was the other one which actually popped up because there was consistency. While making this, I saw that there was a lot of repetition from the same fund house. So of course we'll also try to get in touch with SBI Mutual Fund and Aditya Birla Mutual Fund to get their views on why, and I'm sure that they would have a logical explanation for this.
Okay.
And also, Darshan, for that matter, from the larger fund houses, as per some channel checks, they tend to pass on a part of the expense ratio to distributors in a big way. At least the ones that bring in the HNI clients and bring that big ticket investment. So for them to actually see that little bit what they're giving up, they kind of sort of try to cover themselves also. So the smaller distributor here in this whole change will be the one that gets affected, which will then transition itself towards selling of ULIPs or corporate FDs. And the bigger
PMS and AIF, that's what I think Jayesh spoke about.
Yeah,
also.
so the bigger PMS obviously is big ticket clients. It's just 25 lakhs per ticket, per check.
Yeah.
So obviously the smaller retailer will not go through PMS because it's a 25 lakh ticket. So it's obviously the bigger ones that will see the impact of the same. But thanks a lot, Jayesh, for highlighting that for us. The other one that we're going to be talking about is what's been happening in the cement space. All the talk of government's infra push and the revival in private investments has failed to trigger a turnaround in the cement sector. Annual reports for FY18 show that capacity utilization is still subpar and pricing power remains elusive. Nikki Mirchandani, she's put together the financials and commentary from 5 largest cement makers. Nikki, what are the discernible trends that you're seeing?
Sure, Devin. I'm going to start off with the outlook by the 5 majors that have reported their annual report for FY18. They've painted quite a mixed picture for that matter, where some of them have painted an extremely rosy picture and the other ones have painted a grim scenario. I'm going to start off with ACC, which has mentioned that there is an intense competition and there is not enough demand pull, and the excess capacity situation is expected to correct only by 2019. Ultratech sees some kind of headwinds with a higher fuel price that may impact the margins. You have Ambuja Cement, which has not spoken about the sector, has just spoken about the economy and the green shoots. Shree Cements, which has painted a mixed picture, says that the demand is expected to improve, but then they do see some amount of concern from energy and logistical costs, which have been on the uptrend. Ramco Cement, a positive picture, which says that the government policy focused towards construction and infra is definitely a positive for the sector. The subpar capacity utilization, which glorifies the excessive supply scenario that we have currently in the industry. Let's start off. Actually, only 2 of the players, that is Ultratech and Shree Cement, they have added meaningful capacity. And if you look at the capacity utilization levels, they're around that 70% kind of a level, indicating that there is more scope to utilize their capacity. And if you look at the Ambuja and ECC numbers, you would see a 78-79% kind of utilization for FY18, but then there have been no capacity addition for these 2 companies. Let's look at the capacity addition which have actually took place for Ultratech and Shree Cement. For Ultratech, you've seen the JP acquisition, which has significantly taken higher the installed capacity from 66 MTPA to around 85 MTPA, and then you have Shree Cement, which has added another 5 MTPA. ACC too added some capacity, but that was negligible to an amount of 2 MTPA for FY 2018. The main concern here that I'd like to highlight is the return on equity, which has been stagnating for most of these players. Now, if you look at the Ultratech Cement numbers, ROE there has come down from 11.5 to around that 8%, and for Ramco Cement too, it has declined from 19 to 14%. So, you know, and rest of all the other players have either sustained. It's only ECC which has managed to actually increase the ROE. Most of the brokerages have a negative view, but then I'm going to put out the mixed picture here. IIFL says that they expect the ROE to remain depressed for 2019. They expect the cost to actually go higher given the rupee depreciation, and they also see a concern in maintaining the profitability that we've seen for FY17. Deutsche Bank, on the other hand, says that cost curve and supply analysis suggest that the price hike is imminent, particularly so in the northern region. However, they also agree to the fact that cost pressures are expected to keep the earnings weak, at least for near term. Back to you guys.
Okay, many thanks for that, Nikki. So certainly cautious views coming in, and ROE contraction is something that we need to watch out for cement companies. But one sector we want to talk about is the mid-cap IT sector. It's standing tall amid the rupee weakness and the stock market correction. Basically, that's the IT technology, and they have outperformed both the benchmark as well as the broader market indices this year. But there's one outliner within the entire sector, and that's Hexaware, and it's fallen behind the result. Returns, one of the reasons is the big block deal that happened. Agam is standing by to tell us what probably will work for Hexaware and probably what could go ahead. So it's mainly a bull or bear. It's a bull versus bear case scenario that we're putting out on Hexaware. So Agam, tell us the bull case and then tell us the bear case.
Right. So, Darshan, I was running the returns against the Nifty IT company of Hexaware. And what we've come to understand is that Hexaware has been, lagging the entire index for that matter on a 1-month basis, 3-month basis, or for that matter on a year-to-date basis, as you can see on the screen. Now, we did see Hexaware correct to quite an extent just a few weeks ago. This is after its promoter entity, HT Global, went ahead and sold about a little over 8% stake in the company. Since then, we saw that correction come off. And, well, after that, following that, we've had 2 broking houses go ahead and upgrade Hexaware Technologies on the prospects and perhaps the outlook there. So we thought that it would be a good idea to discuss the pros and cons, that is balances the bullish arguments against the bearish arguments for Hexaware Technologies. So what's really working for Hexaware? And among the bulls, as they have mentioned, it's currently signed two very large deals worth $100 million. And in the near term, of course, the weakness in the rupee, of course, augurs well for the entire industry, including Hexaware. We have to remember that Hexaware is in a certain niche of services, and the demand for these specific services has picked up quite substantially, and that's something that's working out for Hexaware. Don't forget, the company has upgraded its 2018 guidance from 10 to 12% to 12 to 13%, and that is something which is encouraging. And the healthcare vertical, of course, is gaining momentum, and these are some of the key arguments that the bulls are making. What is it that the bears are wary of when it comes to Hexaware? Well, firstly, the margins outlook, which has remained volatile and it's also lower than peers. So that is something working against Hexaware. Let's not forget it has very high client concentration, and this could be a risk. Also, the fact that it's the valuations. Now, the valuations are a key concern, and it's been mentioned by even some of those who are bullish on the stock. So FY19 price to earnings ratio for Hexaware is at 24 times, and it's only lower than Mindtree and TCS. It's a lot higher than even the likes of Infosys, Wipro, Tech Mahindra, or HCL Technologies, which is from the large cap space. And that is going to remain a concern for now. And finally, just want to mention the analyst ratings here, where we have about 24% buys, 24% sells, and 24% holds and 52% sells. And that could be an issue, but considering the spate of upgrades that we had in Hexaware recently, well, we're just going to have to wait and watch whether or not things are about to change.
All right, Agam, we'll leave it at that. Thanks very much for that. So that's a bull and bear case for Hexaware. But that's all we have on First Word today. We've got lots more lined up on IndianOpen, and let's highlight that for you. So SEBI has decided to lower expenses paid by investors of equity mutual fund schemes. Now, how will this move impact the mutual fund industry? We are Santosh Singh of Haitong Securities and Sunil Subramanium of Sundaram Mutual Fund. And we discuss the opportunities for Indian drug makers as China faces supply disruptions with Adhish Patil of Aarti Drugs. But after this break, we take a full tilt towards the day's trade and tell you how we are set up to open this morning.
Good news, got a promotion and a damn good raise.
Congrats, beta.
वाह, raise? अब तो insurance policy ले ले.
कौन सी कंपनी से लूं?
Choose वही जिस पर हो पूरा भरोसा.
That's good. But आज की generation wants everything online. Easy premium payment options, loan facilities, और wide range of products.
Papa, Didi, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC. Trending with times. 62 सालों से हर generation की पसंद.
Dreamers. They're everywhere. You've met them, been to school with them, worked with them. They didn't seem different. Yet she's the one who surprised everybody. His crazy idea actually worked.
They are not different. They are you. When you take a chance on yourself.
These are the dreamers who found a way to run the engine of the world. These are the entrepreneurs. There is no formula. There is no right place, right time. There are no overnight successes.
But there is toil, there is preparation, and there is tenacity.
There is no end of the road, no obstacle large enough. There's just the vision and the heart that won't give up.
Because Agons of business never stop.
Agons of business never stop. Only on Bloomberg Quint.
Hi, I'm Jatin Khimani. I'll be at Investors Carnival this year talking about the art of selling stocks. Watch me on Bloomberg Quint.
Welcome back. You're watching Indian Open right here on Bloomberg Quint. Let's quickly look at the Asian market setup before we get you a few more prominent market voices. It's a good day for the Asian markets. A recovery coming into the Nikkei 225, which is up about 1.5%. Shanghai has moved up as well, so the bounce is coming from yesterday's trade too. And Hang Seng, which is trading higher by closer to 2%. Remember, Hang Seng had moved into a bear market territory, but looks like it's slightly bounced off from there. So from January highs now, it's off by 17% instead of the earlier 20-21 odd percent that we're seeing. For SGX Nifty, a quick look at how we are set up for trade. The early morning check, indicated a slightly positive start. We've not gone anywhere from there, so still just 0.25% higher for the SGX Nifty, trading at 11,341. But before we get in and get you some internals of the market, let's welcome in James Sullivan, Head of Equity Research for Asia ex-Japan at JPMorgan. He joins us from the JPMorgan India Investor Conference, which is happening in Delhi. James, thanks very much for taking out the time and speaking with us. What's been happening in the emerging market equity basket in terms of the market performances? The MSCI Emerging Market Index itself is moving towards the bear market. Shanghai now is down 23% from its peak in January. We saw the same with Hang Seng earlier on. So it looks like the sentiment is just driven lower because of various factors. Do you see that changing anytime soon, or it's still going to be a little bit of a way down?
Thanks very much for having me this morning. I would say there's two primary drivers of emerging market performance relative to developed markets. Number one is the earnings growth differential in emerging markets relative to their developed market peers. Number two are currency trends. And on both counts, we've seen actual numbers that have been very negative for emerging market performance on a year-to-date basis, which in JPMorgan's perspective is what's been driving that underperformance year-to-date. Now, the key question, as you say, is very much the outlook moving forward. We are looking at positioning in the US dollar, which has dramatically changed from January. In January, almost the entire market was short the dollar. Now almost every single market participant is leaning long the US dollar, so dramatically different positioning. In emerging markets as well, you went from a situation where you saw very significant EM outperformance in 2017, very long investor positioning, which again is no longer the case. So from a market positioning perspective, both in the dollar as well as EM equity markets, we do think we're looking at the potential for outperformance moving forward. What we need to see from here is stabilization of the US dollar and selective earnings upgrades across the emerging markets here in Asia.
Good morning, James. Hi, this is Darshan here. What's the sense at the conference when you speak to people? You must have spoken to people there, here in India, across Asia, before you came here. What's the sense that investors have for emerging markets and especially India?
The conference is actually just kicking off, and so we'll learn more over the course of the next couple of days. We've got, I think it's 4 cabinet ministers from the Indian government presenting, as well as a very large number of CEOs and senior management officials from some of the key Indian corporates. What I will say is we're looking at an interesting situation for the Indian equity market. Number one, investors are actually positioned very long India. That's very different from what we see in regional markets like China, as an example. Number two, if I look at the earnings revision trend, which we just referenced, earnings revisions here in India have been very negative over the course of the past couple of quarters, but I'd make 2 points. Number one, we're starting to see a moderation of those negative earnings revisions. In the past quarter, it was actually the smallest negative earnings revision that we've seen over the course of the past 4 quarters. We're also starting to see some specific sectors pick up and actually see positive earnings revisions. And so specifically, I'd mention healthcare, IT services, as well as manufacturing. So a lot of our sectors that are more exposed to the currency trends and actually benefiting from some of the INR weakness that we've seen over the course of the past couple of months.
That points it out to the macro side of things, the earnings, internal, corporate performances. But on the macro side of things, we still face pressures. While the GDP growth numbers look encouraging, optically, if you look at CAD, what's been happening at it being at a 5-year high for the country now, fiscal deficit pressures considering currency weakness. Does that paint a really, risk-averse picture for someone sitting outside India and trying to make investments?
I think it's important to recognize where we've come from and where we're going moving forward. Where we've come from is an environment where markets had absolutely not priced in a more aggressive Fed, particularly into global bond markets as of January this year. We now think that the level of rate increase and rate hikes that we have in the forecast, which is every quarter from now until the end of 2019, is adequately priced into global bond markets. And that has a very meaningful impact in terms of currency trends moving forward. Also particularly relevant to the Indian market is we are sitting with oil at close to a 4-year high. We don't see significant upside to oil moving forward. If anything, there's some supply side risks to the upside, but we don't see as meaningful a move over the course of the next 6 months as we just saw on a year-to-date basis, which should indicate that some of the pressure that we've seen on current account deficits across the region, but particularly here in India, do begin to mitigate on a go-forward basis.
James, you highlighted what's been happening to crude, and I want to pick up from that point because yesterday, we had news that Saudi Arabia is okay with crude being at $80 per barrel. I mean, now you've got the Iran sanctions coming up in the month of November. Supply constraints are going to be built in. Do you see that as being a significant negative in the near term?
So there, as you say, there are very clearly some supply constraints to watch out for. 2 points that I'd make. Number one, those are very well known and are very much priced into forward markets for the overall energy complex in our view. Number two, the other side of the equation is obviously the demand side of the equation. At JPMorgan, we just took down our GDP growth forecast for both the European Union as well as Japan, and we're looking at the U.S. as really the sole driver of the global economy at this stage. So on the demand side, I think we can start to highlight some potential areas of weakness moving forward that may start to offset some of the supply concerns that we've had.
Internally, what are the targets that you have put in as far as crude is concerned? Where do you see it topping off, or do you see the rally probably continue?
So again, incrementally, there are some supply side risks to the upside going forward. We think that is offset by some of the demand side of the equation, as we just discussed, as we see relatively flat prices moving forward.
And a word on the ongoing trade issues between the US and China. What's your take on it?
So we've publicly taken the view that there is very little hope for an off-ramp to these conversations in the near future. Ultimately, we've seen several polls come out of the United States over the last couple of days that show that high tariffs are a winning electoral issue for the Republican Party. So the idea that they're going to back away from this issue as they walk into a very contentious midterm conversation, I think, is very unrealistic. If you then look at the politics within China itself, it's hard to argue that President Xi will start to back away. And they've made very public comments that they will not bend to the pressure that they're currently seeing from the United States. And so I think the base case has to be a continuing ratcheting up of trade tensions, that the tariffs that have been discussed as possible will actually become reality, and that it's very difficult to see this situation getting better in the near future.
Just one last question from me, James. Historically, an election year and the run-up to the election year has been positive for the equity markets. Up until a few days back, before the correction started on the Indian indices, we actually had a good 10% bump up on the Nifty as well as the Sensex. Do you expect volatility to be a key factor that could weigh down sentiment, and we need to watch out for it very closely?
I think volatility is absolutely the most important word for this market over the course of the next 6 months. If we look at our FY19 index targets, we've got about 10 to 15% upside for the broader Indian indices. But as you very rightly say, the market has performed well, particularly relative to the rest of the region. We have a situation where investor sentiment as expressed in positioning is already very long. And so we need to see incremental drivers of outperformance. It's difficult to say that you will continue to see the type of valuation push to the market that we've seen over the course of the past 12 months. So our belief is it absolutely has to be based in the earnings cycle. And there we'd be very selective. As we said at the top of the program, we are seeing selective positive earnings revisions. I'd specifically call out healthcare, IT services, and the materials space. Again, those sectors that are more leveraged into INR weakness are the ones where we're starting to see this turnaround and starting to see a broader basis for outperformance moving forward.
Got that. James Sullivan, thanks very much for joining us. It was a pleasure chatting with you. So, JPMorgan there, optimistic on IT and pharma and materials. Let's get in an important market voice then. Mehraboon Irani, MD and CEO at Gini Gems Consultants and Investment Advisors, is joining us on the show this morning. Mehraboon, thanks very much for taking out the time. Looks like, we've seen some bit of caution creeping back into the markets last few days and not augured particularly well for the indices.
Yeah, that's true. I think over the last 6-7 months, what happened is the Nifty index, the Sensex scaled new highs, and it was largely led by 8 or 9 stocks. So portfolios never did all that well of many investors. But over the last 1 month, we saw a distinct momentum coming back in the market. The side market started doing well, but last 10 days, they seem to have petered out. As the uptrend got broken, my viewer's answer is a certain yes. Is it a market which is sell on advance? My answer is yes, because market can see over the next 6 months, and over the next 6 months, you have only negatives, concerns being seen. Bond yields above 8%, oil at the present price, rupee at its all-time low. I think US-China trade war, every day you hear something else coming up. Iran sanctions. And I think over the next 10, 15, 20 days, you and I possibly would be discussing the 4 state elections coming. How will it impact the next year general elections? I personally believe all these negatives will get somewhere built in the indices. At what level? 11,000, 11,100, 10,800. Honestly, I don't know, but it will certainly get built in. And my view is simple. This is a bull market, a clear, strong bull market. India is in a bull market because bull market is built out of economic expansion. Economic expansion has started. Credit offtake has picked up. Investment cycle has picked up. Corporate earnings are growing. Tax collections are buoyant. Why is the market not seeing all this? Because right now the market is completely blinded by the concerns. Normally market can see 6 months ahead. And as of now, I think there is a downtrend, and the downtrend possibly, according to me, will halt somewhere. You and I will say, oh, now the negatives are in the price. Ultimately, there are positives also. And the market, the bull, which is right now lying somewhere in, has got scared, will suddenly become ferocious, come up again with rate cuts. So I personally see that thing happening possibly over the next 3 to 6 months. What will be the triggers for that? It could be somewhere an impression in India that ultimately this government will come back to power. And from the US, I think what could be the biggest trigger, according to me, is the US Fed, which will signal that, oh, interest rate hikes will not happen that much as what happened in 2018, somewhere in 2019. The dollar will retrace. I personally believe that will happen maybe over the next 2, 3, 4 months. And when that happens, I believe emerging markets will again move up and India will be an outperformer among them.
Okay, Mehraboon, just hold on. We have an important development that's come in. Some updates from the commodity space. Market regulator SEBI has enabled foreign investors to deal in commodity derivatives. The regulation applies to all commodities except for those classified as sensitive ones. Let's get in more perspective on this from Mrugang Paranjpe, the MD and CEO at MCX, who joins us on the phone line. Mr. Paranjpe, thank you so much for joining us. First of all, yesterday SEBI came out with this notification in terms of where FI participation can happen in the commodity business. How are you reading into this development that has come in?
It's a very positive development for the commodity derivatives market. I think in terms of steps, and we keep talking about some baby steps and some big steps, I think in that sense, it's a very big step in allowing foreign participation into the commodity derivatives market. We see this as deepening the liquidity and in the long run, actually helping India become a global price setter in some of the commodities. Of course, we have to temper our expectations that this may not happen in every commodity, but I think this is a very, very positive step that we see yesterday from the regulator.
So to just get a sense of what's happening, currently what is the status? Who all are allowed to trade in commodities here and who all are barred? And post this regulation, how is that going to change?
So currently in India, we allow Indian corporates, we allow Indian retail, but when it comes to institutions, even on the domestic side, we only allow alternative investment funds category 3 to invest, and we are still awaiting the SEBI regulations for allowing mutual funds and PMS providers to be participating on our commodity derivative exchanges. Foreigners of any type were not allowed to trade in commodity derivatives till now. And what has happened with the announcement yesterday is that foreign entities who have an exposure to Indian commodities will now be able to hedge those exposures on the Indian exchanges. So I think it's an opening. It gets in the physical participants internationally who have exposures to India to now hedge on Indian exchanges. But in the long run, this will enable a lot more participation even from foreign portfolio investors.
All right. So just to clarify, they can only take hedge positions. They can't take a directional or a discretionary trade in commodities on your platform. And second being, what exactly are the kind of volume figures that you're currently anticipating? I mean, currently, having versus an anticipated uptick in the volumes?
So two parts. I don't think we have the full clarity on whether it's only a hedge position. I think what has come yesterday's press release is that as long as they have an exposure, they will be allowed to trade here. So they need to have a demonstrable exposure.
Yeah, but I think they've also clarified with regards to the tenure of that trade that they can take. So the tenure of that trade should not exceed the tenure of the underlying asset that they have. So technically, which indicates that it's primarily a hedge position.
On the other part, in terms of the volumes, I think too early to guess. So we need to, not just see the fine print, but I think we just need to allow this market to develop. In that sense, any derivatives contracts in any exchange takes, anywhere between a year to 3 years to develop. That's been the experience in India as well, whether it's equities or in commodities. That's been the international experience as well. So I think we wouldn't want to hazard a guess on volumes. Our view is that these are long-term initiatives. Over the next 2 to 3 years, we could see India becoming a real deep market for some of the commodities where people will start trading in India and start trading elsewhere.
Just to understand from you, is this going to be a special window for them, or they're going to trade on the same platform? Because according to channel checks, some client codes which are allocated to Indian firms trading on commodities platform, they have very limited, limits. Their limits are capped. So if an FPI or a foreign investor is coming to take a hedge position, it's probably going to be a larger quantum. So will they have a separate window? Will their limits be more than those which are offered to the current firms trading on the platform?
So I think we again need to see and wait for the detail. But if I have to hazard a guess, no, there won't be a different platform. I think we will have the same people trading on the same platform. As regard limits, even today, as long as Indian hedger has demonstrable requirements which can be demonstrated both to the exchange and thereafter to SEBI, there is no limit as such in terms of saying that there's a reduced limit for investors. The limits are given based on the hedge requirements that people are able to demonstrate.
Okay, Mr. Paranjpe, the final question from my end at least. When will this be coming into effect? Any clarity on when this will actually go on live for you?
I don't think we have a timeline yet, but if you have seen what has been the trend with SEBI in most of these things, post a board meeting, it takes normally a month or two to get the detailed guidelines. In this case, I think we'll have to wait for two guidelines. One is what they have mentioned about how these entities can trade with brokers. So there's a guideline on that. And second, I think because, again, these are foreign entities, this will somehow get linked to the revised foreign participation guidelines. So I think between the two, maybe a couple of months for the guidelines to come in, and then we can start expecting these participants to trade in India.
Okay, Mr. Paranjpe, we leave it at that. Thanks so much for speaking to Bloomberg Quint. Mehraboon, good morning. Hi, this is Darshan here. Just to follow up, the most important news that came out yesterday was the SEBI meet in which, there was news on this commodity, which definitely benefits MCX. And more importantly was the capping or the cutting of TER for asset management companies. Any word on, how that will pan out for companies?
Ultimately, we think it's a clear-cut negative for AMCs. I think AMCs were charging what they were charging. Brokers will need their pass-through. Maybe there will be pressing of demand as far as reducing brokerage cost goes. But at the end of it all, on the whole, this is a negative. And as a business also, if you allow me to state this, I think the valuations at which some of these AMC companies were going, I think I was asked this question on your very channel, I think a couple of weeks ago. I do believe that quite a few of them are at extremely expensive valuations. Now, would this be a reason for the stocks to correct? My answer would be yes. So I think this is a clear-cut negative. As far as commodities goes, I do wish to appreciate the fact, and this was something which was expected for a long time. At last, it's happening. Even yesterday, I think the of 3 public sector banks getting merged. I would say that there is a lot of, we have become very cynical. Anything as far as PSUs goes, we start looking at things from a negative angle. But I think somewhere this was the need of the day. And somewhere we need to appreciate that economics is being kept out of politics and the banking reforms are continuing, because that was the need of the day. In fact, if you had asked me a year ago, I would have said the only problem with India is we need to fix the problems of the banks. So that was positive. Commodities thing is positive. As far as the AMC thing goes of SEBI, I think it's a negative as far as the revenues go of AMC, and that could possibly reflect on the share prices of AMC companies today.
All right, Mehraboon, just stay on with us. Time to get in our technical experts to talk about trades on the index as well as specific stocks. We've got Brajesh Singh and Brajesh Bhatia joining in. Gentlemen, good morning to you. I'm going to start off with you, Brajesh Singh, your call on the index, and you can carry on to your stock calls as well.
Good morning, Devina. See, no doubt the Nifty has been trading on a wild swing after making a lower high formation, and on the previous swing high was 11,600, 11,603, and from there we have seen a profit booking, and which made a Nifty to touch a low of 11,250. Again, it had bounced back. So it's been trading on a lower highs and lower lows formation. But I think the lower high formation would be stopping by a day or today, because I'm looking Nifty at least holding the previous 52-week high. The previous 52-week high was 11,170. So keeping that thing in mind, and even the oscillator on a lower time frame have been on a oversold zone. So we might see a small pullback, but overall the trend has been down. So at keeping that thing in mind, on a technical basis, right now we can say that still the trend has been a little bit down. So we'll go for a short side. Anything somewhere around 11,280. We'll go for a sell side with a strict stop loss of 11,300, and downside we have a target of 11,200 or 11,170.
Okay, what about individual stocks? What are the stock-specific strategies? This is for Brajesh Singh again.
No doubt, as we know that whenever this type of wild swing happens, so the best part would be the IT or the FMCG and the pharma stocks. And in that, ITC looks good on the chart. On an hourly chart basis, the stock has been trading on the higher lows formation, with oscillator giving a positive divergence, which has been a bullish sign for it. So one can take a buy call somewhere around 301 or 302 with a stop loss of 296 and look for a target of 310. On a positional basis, if someone is looking, then 292 is a support, and the target is somewhere around 317 to 320. Another call would be a Biocon. Yesterday we have seen a stock been on a positive side. So somewhere around 670, 672, one can take a buy call. Your stop loss would be 655. Your target would be 695 to 700 rupees.
Okay, I want to go across to Brajesh Bhatia also. Brajesh, this one's for you. Your index strategies, and also just followed up with the stock strategies.
Yeah, Darshan, thanks. On Nifty, I would probably wait for the previous low, which has made market around 250. So in case that would be the crucial level to watch for the day today. And even if you look at the 50 days average, it's just near the previous low. So I would slightly wait for a momentum to either take markets above 300 or below 235 to take a call. I would slightly wait for Nifty. But if I look at the bank Nifty, it's been slightly under pressure. year with the heavyweights like HDFC Bank, Kotak Bank and Indus Bank been dragging down. So I would look for a sell on Bank Nifty futures at around 600-630 zone, and probably look for the targets just below 26,400 levels on the futures, and one can keep just stop loss about 26,718, 720 sort of levels on the upside. Why? Because if you look at the derivative structure as well, we have seen aggressive writing coming out the higher levels as today is the weekly expiry, and I think this momentum might slightly drag down in the first half of the day towards 26,400, 26,450 levels on the Bank Nifty. And in case if we see addition in the 26,300, 26,400 puts on the downside, there could be chances of reversal. But overall, we think yesterday's addition towards 26,300, 400 indicates that market is slightly dragging down on the Bank Nifty. On the stock side, I would go long on Biocon. If you look at the Biocon, it has a general tendency of giving a cup and handle breakout on the short-term charts. And again, this is history been repeating on the Biocon. And yesterday, the strong momentum with the volumes have given a breakout of cup and handle on Biocon at around 670 levels. So I think at around 677, I will look for target of around 710 with the stop loss of 661 on Biocon for 2 to 3 days. Another stock I'm looking for a short is Dish TV. Why? If you look at the charts, we can see the triple bottom breakdown on the point and figure charts, which clearly indicate the stock is under pressure for quite some time. And for the multiple reasons, stock was unable to breach 68.5 levels on the futures in last couple of weeks. Yeah.
Okay, so pre-open starting, I'll come back to you on your stock, but let's see just 5 seconds for the markets for the pre-open session to start. So let's see what exactly is it throwing up to us. Let's pull up the Nifty, the Bank Nifty, what exactly is happening. The Nifty is trading up 28 points, 30 points as indicated by the SGX Nifty. The Sensex is up almost 230 points. Pull up the Nifty, the Bank Nifty and the Nifty PSU Bank Index to get a sense of what's happening there. Let's see the mid cap and the small cap index. Okay, stock specific, Hindalco starting up by almost 2%. BPCL is another counter which I want to point out, which is up almost 2.7%. Let's pull up the important ones. HDFC AMC, let's see whether it's reacted negatively, and Reliance Nippon. So HDFC AMC is down 5% in trade, seems like a lower circuit. Reliance Nippon is down 3% in trade. Let's pull up MCX to get an indication of what's happening. It's a positive move for them. So MCX is up almost 10%, but remember these are pre-open sessions. Some of the PSUs are doing well. I saw BPCL up almost 1%. Coal India is up 2% in trade currently. Asian Paints has managed to move up in trade. What is not doing well is Titan. Titan is showing me a downtick of 2.5% currently. That's what I'm spotting at this point of time. Devin, anything that you're spotting?
Well, from the broader markets, actually, Hathaway is showing you a cut of about 10-odd%. And remember, the stock in the recent past had rallied up to a level of 26. From there now, it looks like it's coming under some bit of pressure. Quality is another name that's been under pressure of late. The stock's down about 5-odd%. There's been a downgrade on its long-term as well as short-term loans, so you've got some pressure there. Max India is down 4%. You've got Gen Irrigation, which is down about 2.5%. Shree Infra, which seems to be under pressure as well in today's session. So the start seems to be positive, and a few other stocks. IndianOpen Transport, actually, yesterday's session was strong. Today's session looks like it's opening with gains of about 20%. That's the initial take. These figures will consolidate in due time. Adena Bank yesterday was locked up on upper circuit. The pre-open tick post this merger seems, the cheer has continued into today's session as well, 19.5%. And from the sugar space, your usual suspects that seem to be doing well, the likes of a Bajaj Hindustan, which was up at 10% yesterday, seems like the pre-open ticks are up about 9% in today's session as well.
Okay. So just to point out on IndianOpen Transport, they got a refund of an order that was there. So that's,
I think 450 crores.
Yeah, so that's a big refund for them.
From NHA.
So that's why I think it's managing to move up in trade. Okay, a couple of brokerages that came out today. Somit Sarkar is here joining us with all the key brokerage picks. Somit.
Good morning, Darshan. And the big brokerage calls for the day. First, we have is Nomura on JSW Steel. Now, the brokerage has initiated coverage on this stock with a buy rating and a target price of 484 rupees, which suggests a potential upside of nearly 19%. Now, according to the brokerage, JSW Steel is a leading player on Indian steel revival, and Nomura is expecting the Indian steel demand to grow nearly 5 to 7% over the next decade on the back of large-scale infrastructure spending and consumption growth. Now, for JSW Steel, a combination of cost efficiencies and timely capacity expansion would drive the profitability for the company going forward, says the brokerage. Lastly, the brokerage is also expecting the company's balance sheet and debt metrics to remain strong despite the heavy capital expenditure plans of the company in future. Second, we have is Axis Securities on Sheela Foam. Now, the brokerage has initiated coverage on the stock with a buy rating and a target price of 2,039 rupees, which suggests a potential upside of nearly 22%. Now, according to the brokerage, strong brand awareness among consumers will give Sheela Foam a competitive edge over peers. Now, product expansion, introduction of low-price products with sub-brands, and utilizing their know-how to produce higher margin products are all positives for Sheela Foam in future. Now, the company will be setting up a new plant and will also be investing in its existing plant. And for these investments, the company has a strong cash flow position, says the brokerage. Lastly, an expected fall in the prices of its major raw material, that is TDI, will further increase the margins of the company going forward, says the brokerage.
All right, Soumya, thanks very much for that. Just a quick check on the currency as well as the bonds. Yesterday's session was a record low for the Indian rupee. I think 72.97 in intraday trade towards close. Seems to be picking up a bit. So 72.79 is where it's trading at. Mehraboon, what is it that we need to watch out for in terms of stock-specific activity?
Well, I personally believe, as I mentioned earlier, that we are possibly in a downtrend, which somewhere will get discounted at around 11,000, 10,800 levels. If you ask me, frankly, there is a lot of value in quite a few stocks. If you ask me to specify some of them, and I'm saying purely from a longer-term angle, I would say Ambuja at the present level, maybe with another 5-10 rupees possible downside. I think Qualifies is a great buy. I think something like a Bharat Electronics, where all the negatives regarding this contract pricing, according to me, has been more than discounted at 80, 82, 83, I think is a great steal. Deepak Fertilizers looks very interesting to me, and from a very long-term angle, maybe 1 year or more, among the frontline IT stocks, I think Wipro, which has been relatively under-owned stock at the present level, I think valuations, and I somehow feel over the next 1 year the growth should be good. I think stands tall. As far as growth companies goes, I continue to like something called Sterlite, and a new name I have added with a clear disclosure I advise my clients to buy is a company which is in a sector related to railways. I think that is a company called RITES, R-I-T-E-S. I think at around 250, 255 is a great steal according to me.
Okay, Mehraboon, you just spoke about Deepak Nitrite, right? What's the play there? What's the rationale that you're putting in? I believe the plant is the new plant. Oh, I'm sorry, you said Deepak Fertilizer. What's the rationale there?
I think Deepak Fertilizers, if you ask me, as a stock valuation-wise, absolutely attractive. If you look at the way the stock has come down, promoters have just put in money. They are going in for an expansion. They have taken the shares, the equity has gone up, promoter's stake has gone up, and all this has happened in the last 1 month, but this was in play over the last 6, 7, 8 months. So somewhere along the line, a dilution of equity is something which the market is not liked. And fertilizers being a very capital intensive sector, ultimately the fruits from this expansion will play out over the next 1 to 3 years and not over the short term. So considering that the earnings will look a little bit compressed on a bigger equity, the stock had come down. But at the present level, I believe, in a company in which promoters in the present market scenario have put everything themselves, a company which otherwise has behaved very well in terms of governance issues as well as promoters' interest in the way they have run this company, I think at 240, 245, a stock which has seen a price of 400, 410 just less than 6, 7, 8 months ago, I think at this present level there is nothing to lose.
Deepak Fert there at 247. The other bunch, Mehraboon, and post the announcement of increase in ethanol prices, we've not been able to get your view on that. But what's the sense, and how big a positive is this for some of the sugar companies? Because they seem to have been having an unabated rally, at least for the likes of a Bajaj Hindustan, which seems to be up again in pre-open trade by 10%.
I honestly, if you ask me, it's very difficult for money to be made in commodity stocks, specifically sugar. I think if you look at the trend over the last 10, 15 years, I don't think investors have made money. But at the end of it all, there are those periods where the stocks suddenly start flying. And this could be possibly one phase. I think if you look at the book value of some of these companies, I think it's a clear indicator that quite a few of them, which otherwise were well-governed companies, like say Gini, I think there was an opportunity to buy. But as a story, as a fundamental story, speaking for the longer term, it becomes difficult. But the events over the last few days, I think somewhere has brought some life back into the sugar stocks. Could the uptrend continue for some more time? The answer is distinctly yes, because 90% of people who were in sugar stocks just a year ago who were speaking Congo about it have actually not only lost the money in the last fall, but have possibly exited. So absolutely under-owned sector this had become. So this uptrend which has started possibly could have some more steam in it. It's also got to do with the ethanol usage, ethanol prices. So at the end of it all, this is definitely a positive. But if I had to try to take advantage of this announcement regarding ethanol from the government, which came 3 days ago, I would possibly play a better proxy, and that would be Praj Industries at 102, 103. I think that is a company which possibly has the right technology, whose website possibly is very interesting, and I think ultimately somebody ends to gain. It could be sugar companies, definitely, yes. Also what the government is planning to do of increasing MSP for sugar today, I think that also could be a positive for sugar companies, but I would like to play a relatively safer bet, a company which could ultimately end up gaining from this ethanol story, and that is Praj Industries.
Okay, yesterday's session wasn't particularly great for Praj and Chini. Both were down massively in trade yesterday. Just some chart checks. Brijesh Bhatia, coming to you. For a stock like Hexaware, which has already run up quite a bit.
If you look at the Hexaware, I would definitely look for a longer term if it's a good buy. If you look at the IT, mid-cap ITs have been seen a strong rally, and Hexaware, KPIT, Mindtree all have performed well. So I think for a longer time frame, I would continue to maintain a long on Hexaware and probably look for the targets of around 560, 580, maybe a quarter time. Even if you look at the news where the selling pressure was in where stock tested around 390 levels, it has again gained some good positive momentum on the upside, and the follow-up selling was being unwitnessed. So I think definitely a buy on Hexaware.
Okay, we are just minutes away from market opening, and we'll tell you all that you need to know to stay ahead in trade today. First up, listed AMC players, HDFC AMC and Reliance Nippon will be in focus. SEBI has lowered the expenses paid by investors of mutual fund schemes. Mutual funds will now work with a revised total expense ratio. Both the counters are down by close to 5%.
And that's not all the changes from SEBI. The regulator says it has taken the first step to throw open the commodity derivatives trading floor for foreign entities too. So watch out for MCX in trade today.
Sun Pharma says it has received the European Commission's approval for the antibody drug Ilumetri. The drug is used to treat psoriasis. The counter is up 1.5%.
And RITES has received an additional turnkey contract from Indian Railways. The order is worth 436 crore rupees.
Here's a key brokerage call for you. Goldman Sachs has upgraded Shriram Transport to a buy from a neutral. The 12-month target has been revised upwards to 1491. The counter starts up 1.5%.
Staying with brokerage calls, Nomura has initiated coverage on JSW Steel with a price target of 484 rupees per share, and IDFC Securities has initiated coverage on Dr. Lal Path Labs with a price target of 1,184 rupees per share.
Okay, one stock I want to point out is Titan. CLSA has downgraded the counter. The target price that they've given is 720. The counter starts down by 1.5%. Brijesh Singh, a chart check on Titan.
See, no doubt on the shorter term time frame, the stock had, from 850 or say 870, they have been acting in the direction. We have seen a downside, but till 790 doesn't break, one can take a contra call in it. If anyhow 790 breaks, then strong support lies at the band of 745 to 750. But 790 the support, and 875 is a resistance. So if we trade in this range, then well and very good. We can see a bounce back to the level of 930. But if 790 breaks, then 745 is a strong support. One can take a call in it with keeping that thing as a stop loss, and look forward to a target of 875 in a medium-term time frame.
Significant re-rating also for Titans, already down quite heavily to 812 now. Some of the PSU banks yesterday, it actually was quite a split in terms of the kind of PSU banks that did well versus the kind that lost out in the session yesterday. So the likes of Vijaya Bank and Indian Bank towards the end of trade lost about 7 to 8% in trade. Today's session also Vijaya opens a bit tepid. But Brajesh Singh, anything on these PSU banks? Vijaya, Dena, Indian?
Indian Bank on a 4-hourly chart, stock has been trading on lower tops and lower bottom formation, and the previous swing low of 302 had been broken. So right now that would be acting as a resistance. So if someone wants to play for a sell side, definitely keeping 303 as a stop loss, one can go for a sell side for the target of 275 to 278 zone.
1 minute to go for market opening. Quickly, top calls. Brajesh Bhatia, let's start off with you.
I will go long on Biocon at the opening for target of around 700, 710 on intraday basis.
All right, Biocon. Brajesh Singh?
ITC and Biocon. ITC, the target would be 310, stop loss would be 296. Intraday basis on Biocon, your stop loss would be 655, your target would be 695 to 700, and 696 is a 52-week high. Anything above that, then 725.
All right, so Biocon seems to be the common flavor there. Mehraboon, just stay on with us. We've got 30 seconds left to go for market opening. We'll come back to get your opening thoughts as well, Darshan.
Yeah, okay, so almost 30 seconds for the market to go open, and we'll definitely watch out for, the asset management companies, because they will steal the limelight. The pre-open does indicate that there is a positive traction that will come in as far as MCX is concerned. I'm very interested to see how the oil marketing companies also react. Yesterday was a big cut that came in, so 7 seconds for the markets to go, and we'll come to see what exactly. The SGX Nifty is indicating a positive outlook. We're up almost 50 points. The Nifty pre-open is indicating a 50-point outlook. So we are opening up almost 50 points on the Nifty, 150 points on the Sensex. The Bank Nifty has managed to move up by 100 points. Interesting to pull up how the Bank Nifty PSU is doing. The mid caps are done well. They're up almost 0.5%. The small cap is up 0.3%. So there is enough traction that's happening in the market. The PSU banking lot has opened with a positive bias. Let's pull up HDFC, AMC and Reliance Nippon before we move on to the heat map. HDFC, AMC starts negative. It's down 4%. Reliance Nippon, let's pull that up. It's down 6% in trade. Let's pull up the Nifty heat map and we can see what exactly is happening at this point of time. Coal India continues to be the top gainer in trade. It's doing well. Yes Bank over the past few days has done well. Sun Pharma, the European approval that has come in, that is doing well in trade. Aisha technically over the past few days has been doing well. I can see a lot of green as far as the pharma packs are concerned. So I can see Cipla, Dr. Reddy's, Sun Pharma, they're doing well for itself. The consumption theme, Asian Paints has been doing well. What is not doing well is Titan is down 4% post the CLSA downgrade to a sell from an outperform, and the target price is cut in excess from 1,000 to 720. So they believe that traction won't happening, but very limited stocks, and the list now seems to be going ahead. HDFC Bank continues to bleed. It's down another 0.2%. NTPC is down in trade. The HDFC twins are not participating in this rally. Let's pull up Reliance Industries and see where that is. That's one counter that we need to watch out that could bring in sizable chunk to the Nifty. What's exactly happening there? And we can see Reliance is up flat in trade. Anything on the mid-cap end, Devina?
Well, obviously, you're going to be watching out for what's been happening in the sugar space and some of the PSU banks. But you've got Balrampur Chini, which stacks the top of the list, about 5% higher. ILNFS Transport on the back of that refund. The stock's up about 4%. Praj large industries, Mehraboon like that. He took a call on that one right now. It's up about 3.8%. Hathway is up after losing significant steam. In fact, pre-open ticks sort of settled. Stocks opened about 3.5% higher. Avanti feeds 3 straight days of gains. Today again is no different. That stock's doing well. You've got Sri Lanka Sugars and the rest of the lot, including EID Parry. Some other names like JP Associates, Reddington, Marksons Pharma are doing okay. Amongst the losers, and just quickly highlighting them, Dena Bank is down 8%. Dena Bank was actually one of the key gainers in yesterday's session, but it's down 8% today. UCO Bank, Reliance Communications, Titan, and the rest of the pack like Jyoti Labs, Gen Irrigations down 1.5%.
Okay, so let's take a look at some of the counters which will be in focus today and which we've highlighted that could pretty much be in focus. Obviously, the asset management company, the cuts getting deeper. HDFC AMC is down now 7%. Reliance Nippon is down another 6%. So there is enough traction, and HDFC AMC anyway has fallen from levels of 1900. MCX positive start, the FI participation that probably it will open. It's not opened yet, but nevertheless on that anticipation, positive cues coming in. Brokerage, just 2 initiations that came out. JSW Steel, in which Nomura had initiated with a target price of 484. It's starting up on a higher side. Dr. Lal, it was an IDFC note with a target price of 1184. That starts up almost 3% in trade. So that's positive traction that's coming in. Shriram Transport, after a massive fall over the past few days, we are seeing a little bit of upgrade that's coming in. So that's providing support for Shriram Transport. So that's moved up higher. Balrampur Chini is back in the FNO ban. So it's moved up almost 3%. And today Sugar as a pack seems to be doing okay after the big sell-off that we saw in trade yesterday. Tilranod positive for Sun Pharma. It's up almost 1.4%. A lot of brokerages have come out with positive news on Sun Pharma. RITES has got a new order worth over 500 crores. So that is up almost 3% in trade. A couple of other stocks that I wanted to point out. The big one obviously is Titan. CLSA has cut the target price to 720 with a downgrade. That's the top loser on the Nifty at this point of time. And Nifty seems to be slipping off the highs of the day, Devina.
Well, the mood still seems to be slightly positive, but yes, off the highs of the day for the Nifty Bank also seems to be flattening out. Quick word on the opening, Mehraboon.
I think on expected lines, I think India is going to continue to watch what's going to happen globally for some more time to come. The concerns will continue, the nervousness will continue, and I still believe for some more time to come, I think this is going to be a sell on advanced market. I think nowhere I'm stating that the bull market is not intact. It's going to become much more stronger than the recent phases that we have seen. But for the time being, the concerns are going to get itself discounted in the market. So we'll be watching the rupee, we'll be watching oil, we'll be watching what Asian markets, how they open every morning and accordingly behave here and there. But I somewhere feel 3, 4, 5% lower from here. I think the indices could possibly bottom out. But if that happens, there could be some more blood in the portfolios of investors, because if the Nifty gives away another 3.5%, 4%, where I believe it will bottom out, side market could possibly shed much more weight as compared to the 3% in the frontline indices. So at the end of it all, this is a time where people need to know that a great opportunity is going to come to park money. At the same time, one should possibly look at value buying starting right now itself, and possibly the weaker stocks. Every rise, learn to exit, sit on a little bit of cash. I've been advising my investors to sit between 12 to 20% cash right now and wait for a great opportune moment to come in front of us, which I think should come over the next 2, 3, 4 months. The trigger could come from US Fed, as I mentioned earlier, or it could come somewhere from the political scenario over here, where if the conviction happens that next year we will have the same government continuing the same reform process which is presently on, I think market is going to certainly like it, and the bull animal, I promise you, is going to come with greater ferocity going up.
Okay, Mehraboon, we leave it at that. Thank you so much for sparing time and joining us on Bloomberg Twin today. Thank you so much. A couple of stocks I want to point out. Jet Airways has moved to a 52-week low. It's down after a 4% cut yesterday. It's down another 2% in trade. Sun Pharma is pretty much at the lowest point of the day. HUL moves into the negative point at this point of time. GIC Housing Finance at a record low, 52-week low, sorry. It's down another 1.3%. All the counters have now started coming down on the Nifty itself, be an HUL or an Irani Ports or a UPL. All of them are moving up. Brijesh Bhatia, anything on that you're seeing interesting at this point of time? Markets have opened. You've given, it's almost 5 minutes now. Anything fresh trade coming in from you? What should that be?
I guess HUL would be a good buy. This dip slightly might settle down, and I think if you look at the daily charts, it has given a strong after a sell-off. It has given a rising three-pack candlesticks pattern, and I think this dip could be a good buying level, and around 647, 648 levels on intraday basis, one can look for a buying opportunity on HUL.
And Brijesh Bhatia. Markets have opened. Brijesh Singh, we just went to Brijesh Bhatia. Brijesh Singh, what's your call? Any stock that you're finding interesting at this point of time?
So there are two stocks which look good from a banking sector. For a short sell, one can go for sell with an ICICI Bank. On an hourly chart, the stock has been trading on low high formation. Sell call can be made. 317, 318 has been quoting. Keep a stop loss of 323 or 324. Look for a target of 308 or 305. The Yes Bank look good. Any dip somewhere on 325 or below that, one can take a buy call. Here your stop loss would be 320. Your target would be 331. If any of 331 been crossed with a volume, then 335 can also be achieved in a day or two.
Okay. Gentlemen, we leave it at that. Thanks very much for joining in. Brijesh Singh as well as Brijesh Bhatia. On to an important market voice then. Sanjeev Prasad, Managing Director and Co-Head at Kotak Institutional Equities. He's joining us on the show this morning. Sanjeev, good morning to you and thanks very much for joining in. You know, it's a tricky market to be in right now. Up until a few days back, 10 days back, the exuberance was pretty evident. We had sort of decoupled from the rest of Asia in terms of our market price performances, but looks like external factors were not at bay for us. It's sort of weighing down back on the sentiment within India itself. What's your take on the current stance of the market mood, and how do you expect us to go moving forward?
Honestly, the risks are quite high as far as India is concerned, and they stem from two areas. One is, of course, the fact that global sentiment for EMs in general is weak and could possibly become weaker if this whole China-US trade issues continue to escalate as they have been over the last 1 or 2 days, and we don't know where it ends. And the risk is if China starts suffering to some extent, some sort of slowdown, and one way out of some of the problems that China is facing as of now is maybe weaker currency, then it's going to affect just about every other EM market at the same time. And the second one is, which is more specific to India and probably impacts India more than other emerging markets, is the whole Iran-US issue and what it could do to oil prices. So currently, if you look at our current account deficit, we are pushing 3%. And God forbid if oil goes up higher, if you see a lot of Iran oil being removed from global oil markets, not being replaced by the likes of Saudi, Russia, etc., then crude prices could go up significantly, and crude has a very perverse impact as far as India is concerned in current account BOP currency, and also on fixed borrowing, as also on inflation interest rates. So in general, all our macroeconomic parameters could get weakened if crude prices go up $10–15 from where we are. I'm hoping not, but unfortunately there are upside risks to crude prices at the current juncture.
Good morning, Sanjeev. Hi, this is Darshan here. It was interesting reading your note that came out recently on the not-so-curious case of the Indian rupee, where you believe that it didn't deserve the kind of attention that it's getting. Overall, what's your view on the rupee? Is the move, are we at the bottom yet? Do you see more depreciation? Your view on that?
The rupee always behaves in a very funny manner, in the sense, if you look at the last 15 years, it has typically shown periods of strength in nominal terms, which effectively means in real terms it starts getting more and more overvalued. And the moment you start seeing some sort of a global or a EM sort of a crisis, the rupee corrects to its fundamental level. So I think this is one of those episodes, and the last 15 years we have seen already 3 times the rupee has depreciated pretty significantly. You had the global financial crisis in 2008, then you had the Euro crisis in 2011, and then you had the taper tantrum in the middle of 2013. And this could again be I would say a mini EM crisis. So I think the rupee is just correcting to its fundamental level. If you look at any of the RER metrics, whether of the RBI or of the BIS, looks like the rupee is still maybe 3-4% overvalued. It's getting there, I think, in terms of valuation. But the risk we always run is overshoot, which can happen given the whole sentiment for EMs as of now. As I was explaining earlier, if China, starts seeing some sort of a slowdown or start depreciating the currency to support its exports, then none of the currency will stand against that. A lot of other currencies will also probably go down along with the Chinese one. So that is something which we need to keep an eye on. And of course, if crude prices go up higher, that can again put pressure on our current account and BOP. But the view which I had on the rupee was, more on the fundamental basis, RER basis. So in nominal terms, it will, depreciate. So I don't think it's that much of an issue. More importantly, if you look at the external situation as far as India is concerned, it's in a very, very strong position as of now compared to, let's say, 5 years back. Look at external debt to GDP, that's somewhere about 20%. It's much lower than many other emerging markets. So we don't have any real challenge as far as, some sort of external crisis, which we have seen in the likes of Argentina or Turkey. We are far away from that. In fact, we should not even discuss anything of that sort. Not happening in India. We are sitting on $400 billion of reserve. That's about 8 months of import. So, a relatively comfortable position when it comes to the external situation. On the rupee, I think there's a lot of attention on it because obviously, it's after a long time that the rupee had depreciated suddenly. But remember from 2015, the second half of 2015 all the way till now, rupee was pretty much in that 64 to 68 range. It should have logically depreciated every year by 2-3%. It didn't. It's just that in one fell swoop, it's depreciated like 10% over the last 2-3 months.
Sanjeev, going ahead from a market standpoint now, while taking decisions in remodeling or rejigging a portfolio, does one focus primarily on the macros, or it's the micros that take precedence? Things like the earnings performance, how individual stocks and companies are placed to lead growth over the next foreseeable future, and what should your decision be impacted by?
See, it's a very good question. Logically as an investor, you should be focused more on the second part. Just see if the fundamental of the company is, changing, either improving or declining, and whether, some of the improvement or deterioration is already factored in the stock prices. So somewhere you have to always keep on looking at the price value equation for any stock. But at this point in time, since the macro has become so, dominant in the minds of investors, that unfortunately all the focus seems to be on the macro, and in a way market is reacting to very small macro changes. So if you have some concern on rupee, suddenly the whole portfolio positioning becomes more aligned towards export stocks like an IT or pharma, etc. Nobody even cares what the valuation of these names are. Similarly, if you look at the other side, you have some of the corporate banks where things seem to be improving in terms of at least the NPL problem peaking, some resolution moving ahead, and the valuation reasonably, inexpensive. But of course, given the whole macro worries out there in the sense that, maybe rupee could appreciate more, interest rates could rise. So why, look at some of these, stocks, even though the valuation may be fairly supportive. So it depends on what time frame you have. In the more, shorter term, I think the focus will continue to be, unfortunately, the macro. But if you are an investor who's willing more to, overlook some of those macro-related challenges which will come up over the next 6-9 months, there is a good time to accumulate some of the beaten down stocks, which are available at reasonably inexpensive valuations.
Sanjeev, if you have been observing the kind of announcements from the government, from the SEBI over the last 1 week, they seem to be coming in a flurry. You had news regarding the sugar space, which increased ethanol prices, all sugar stocks rose. You had this merger in the public sector space, merger of Dana, Bank of Baroda and Vijaya Bank. Now you have the SEBI, targeting the mutual fund space. What are you making out of this kind of news flows and this proactiveness from the government side?
I think this government has anyway been fairly proactive in terms of doing things. So I wouldn't, ascribe anything to some, desperation that they need to do something at this point in time. This is par for course in a way that, this government has been, fairly reformist in its approach, has constantly been doing things, And some of the moves, the market clearly did not like this whole Bob Dana Vijaya merger, but there is clearly some logic to it. Of course, we'll have to wait and see what kind of merger ratios, swap ratios get announced, and so on and so forth. What is the incremental plan towards improving governance in some of the PSU banks and so on and so forth. So at least I don't mind a government which is seen as doing something. And I wouldn't ascribe any particular motive to the recent flurry of activity. It's probably our minds are a little bit more focused on this, given the whole macro backdrop, I guess.
Just pulling out from the PSU banking space, up until now, they, the focus has been totally on the retail-facing banks. PSU banks have probably been written off a bit. They've come back into the limelight. Most of the larger banks have started upfronting their provisions. Do you see them, the course changing for them, things turning, upwards for them from here on?
Yeah, a lot will depend on what is the eventual plan for these banks. Merger is only one part of it. Club 2 or 3 banks together, that is okay. That's a starting point. The more important thing is the 2 bigger issues, I would say, is, or 3 bigger issues, I would say, is one is the whole issue of capital. How much will the government provide more to recapitalize some of these PSU banks? Remember, 11 out of the 20 PSU banks are currently under the PCA framework of the RPI. Second is, what kind of governance changes do we see in some of these banks? So rightly, wrongly, somewhere these stocks are not perceived as being, very share market friendly, if I can use that term. And thirdly, what sort of incentive structure is there for the managements for these companies to do better? So those are 3 big things which I think the market would like more clarity on, and accordingly, people will react to the PSU banks accordingly.
So Sanjeev, what's the sense that you're advising investors at this point of time? Which are the sectors that you feel that should in the fall that we've seen, should investors should now start taking exposure to?
It's honestly a very challenging way. On the one side, you have stocks which are supposed to be defensive. They're all fairly expensive. Whether it is your consumer staple names, private retail banks. Even pharma now, after the recent run-up, and IT looks reasonably fairly valued again after the massive run-up it had over the last, few months. So those look better from a macro perspective. But if you look at the rest of the market, there's clearly value over there. Whether it is the corporate banks or the so-called corporate banks, you have some of the metal mining names, power utilities. Valuations are extremely inexpensive, but given the macro backdrop, nobody is even looking at these stocks because of the concerns around the macro. So maybe those are the stocks to focus on if you have a slightly more longer term time frame. So it's a critical thing. Say the next 6-9 months, your macro still looks reasonably challenged, and 2 other things on which we have really no control is how is this whole China-US trade issue going to play out? What repercussion does it have on other emerging markets, including India? And then you have the Iran-US oil sanction issue. How does that play out? And in turn, what repercussion does it have on India's economy? And unfortunately, both carry upside risk as of now. And from India perspective, you also have elections 9 months down the line. So all these things create a lot of uncertainty as far as the market is concerned. So you should be prepared for volatility, that's for sure. You could be prepared for even 5-10% market correction if things go wrong on the macro. But I guess you will have to deal with this kind of a volatile market as of now.
All right, Sanjeev, we leave it at that. A pleasure having you on the show with us after some time now, and hope to see you on the platform more often. Thanks very much for joining in. On the other side of the break, SEBI has decided to lower expenses paid by investors of equity mutual fund schemes. Now, how will this move impact mutual fund industry? We will ask Santosh Singh of Haitong Securities and Sunil Subramanium of Sundaram Mutual Fund. And we discuss the opportunities for Indian drug makers as China faces supply disruptions with Adhish Patil of Aarti Drugs.
Good news, guys. Got a promotion and a damn good raise.
Congrats, beta.
Congrats, मेरी तरफ से भी.
From mama too.
वाह, raise? अब तो इंश्योरेंस पॉलिसी ले ले.
इंश्योरेंस? कौन सी कंपनी से लूं?
सोचना क्या? चूज वही जिस पर हो पूरा भरोसा.
वीरू, go for convenience. My company is online, quick and simple.
बेटा, बट पॉलिसी समझाएगा कौन?
वेबसाइट पे सब है पापा. I can even call and ask.
क्लेम सेटलमेंट का रेशो क्या है? मेरी कंपनी का 98% से ज्यादा है.
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
अरे पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC ट्रेंडिंग विद टाइम्स 62 सालों से हर जनरेशन की पसंद.
Dreamers. They're everywhere. You've met them, been to school with them, worked with them. They didn't seem different. Yet she's the one who surprised everybody. His crazy idea actually worked.
They are no different. They are you. When you take a chance on yourself.
These are the dreamers who found a way to run the engine of the world. These are the entrepreneurs. There is no formula. There is no right place, right time. There are no overnight successes.
But there is toil, there is preparation, and there is tenacity.
There is no end of the road, no obstacle large enough. There's just the vision and the heart that won't give up.
Because Agons of business never stop.
Agons of business never stop. Only on Bloomberg Quint.
I want to talk about how disruptions are coming and how we'll have to weave that into our portfolio, into our investment thesis. Because clearly in this whole world of disruption, there will be few winners, but those winners will make tremendous amount of wealth.
Welcome back. You're watching IndianOpen right here on Bloomberg Quint. A quick take on the Nifty as well as the Sensex before we move on into our discussion. Markets come off the day's high, 11,297 on the Nifty. Sensex trading at 37,346, flat for the banks. But the key topic right now of discussion is the mutual fund industry, and mutual fund investors will get more for the buck now. The market regulator SEBI has revised the total expense ratio charged by mutual fund houses, choosing to bring in a tiered structure. So what is the impact? What does this have an impact on the net asset value, and how will it impact the mutual fund house earnings? Joining us now to talk about this is Sunil Subramanium, the MD and CEO of Sundaram Mutual Fund, and Santosh Singh, the head of research at Haitong Securities. Gentlemen, thanks very much for joining in. I'm going to come to you, Mr. Subramaniam, first, and your initial take on the announcement that came in from the SEBI.
Well, if you see the announcement from SEBI, there are three stakeholders in the industry, right? The manufacturers, the asset management, the distribution community, and the investors. So clearly, this is something, I think the number quoted by SEBI was 1,500 crores as savings to investors in terms of expense management fees that AMCs were allowed to charge. So I think that's a net saving to investors who are already invested in these schemes. And in terms of the who's going to pick up this tab between the 1,500 crores between the distribution community and the manufacturer, that's a commercial decision left to each AMC and the distributors it has to manage. So that's the first thing. The second thing is that the larger schemes have had a much further drop than the smaller schemes. So to the extent that large size schemes investors have already invested in, they would see a better benefit in terms of their expenses rather than in the smaller schemes. That being said, on fresh investments, right, naturally the commercials would be better on smaller schemes. So I would expect that fresh inflows would come into smaller schemes in the industry because distributors would earn a little bit better there as opposed to larger schemes. The third impact of this from a thing is that in the larger space of the industry, that is the large cap space, right? This difference of 15, 20, 25, 35, depending on which tier it falls under, would make some difference to the returns because large cap funds overall have generally been just around the benchmark because ever since SEBI moved to a total return index, another 150 basis points got shaved off in terms of the alpha. So at the larger schemes, this would make a difference. And I would say that from a perspective of HNI investors, yes, this would be a significant savings for them. But to a retail investor who's investing in a more diversified pack and mid-cap, small-cap, the alpha generated by mid and small-cap funds over a 3, 5, 10-year time frame is upwards of 300 to 400 basis points. So when such an alpha is there, a mere 15, 20, 25 basis points is not going to make a difference. So to a long-term retail or mass affluent investor, this is not really key because the wealth creation is going to be far in excess of the cost savings. But to a HNI investor, yes, there could be a benefit. The third thing is that from a distribution perspective, like I said, one is a likely shift towards smaller schemes, which are good performing schemes as opposed to larger schemes. But the second thing is that from an investor perspective, right, SEBI has been very clear that he also wants to promote direct investments. So in a way, this is something because now the other hidden rules here are one is that no upfront commission can be any more paid. And second is all commission related expenses have to be paid only from the scheme and not from the AMC. This is fairly significant because upfronts, different people react differently to it. So if you look at it from a HNI perspective, I would say that the large distributors would shift their HNIs to more high risk, high reward products like PMS and AIF, where there's a much more flexible commission structure permitted by the regulator. Whereas at the retail end, new customer acquisition will become a challenge because upfront commissions were a way of defraying the cost of acquisition of a new retail customer. Right. But today, if you take a 1 lakh rupee customer as a typical retail customer, right, and likely trail commissions are going to be 1%. So that means he makes 1,000 rupees per year, right, which is just 80 rupees a month. So a new distributor coming in or a distributor seeking to service the retail end of the curve, he would not be incentivized. So I would see that there the shift would be towards SIPs where the regulator is permitting some upfront.
Mr. Sundaram, do you see a meaningful impact on the gross inflows in these schemes? Do you see that changing materially? And secondly, from an AMC perspective, how does this work out for a ratio like PAT to AUM? Because for every 5 basis points of expense dip that AMCs have to absorb, the PAT could likely be impacted by about 80% on average for the top 10 AMCs.
Are you directing the question to me?
Yes, sir.
See, AMC, you cannot directly take this to the bottom line because AMCs will definitely pass on this cost to the distributors to the extent possible. So like I said, the strength of the AMC, the brand of the AMC to the extent that contributes to their business, they are in a much stronger negotiating position vis-a-vis distributors, and they would be able to pass on this drop in thing almost entirely to the distributor. We had a similar experience a few months ago when SEBI removed the 20 basis in lieu of exit load and reduced that to 5 basis points. There was a 15 basis points drop. And if you see, the larger AMCs had passed on the bulk of the thing to the distributors, and the smaller AMCs is the one which probably in a weaker negotiating position had to kind of share that. So I would say the top 10 AMCs that you're talking about will definitely pass on most of this drop onto the distributors. Hence, I don't see an impact on AMC profits at the top 10. At the smaller AMCs, yes, there is going to be a trade-off between their wanting to grow their business with distributors versus, absorbing this cost.
Mr. Subramanium, just hold on. Santosh, let's get you in this discussion. Firstly, your view, is this move justified what SEBI did?
So I would not go into the justification part of it, but yes, the reasoning was clear, and we were hearing about it because the mutual fund industry, the way it has grown, it has grown quite substantially in the last few years. And if you look at the equity AUMs, it has more than tripled, gone more than 4 times in the last 3 to 4 years. So there was a reason that the overall expense ratio could be cut. How much cut? This was slightly higher than what we were thinking about, but yes, there was a reason why there were talks about that there should be a cut in the overall money which the AMCs were charging to the customers. So that way it was in a way justified, you can say, or not justified, but yeah, in a way justified, because there is an economy of scale building up and the companies were earning more profits. But the part of the problem was whenever they were earning, it has not happened that the AMCs have earned a lot of profit. What has happened is all this money has flown back to the distributor.
Okay.
So as Mr. Subramanium was pointing out, they say the clear path is that the distributor takes a brunt of it. The major of the whatever cut happens, distributor takes the brunt of it. But then the problem which the mutual fund industry will face, that there are rival products. So you have got the AIFs, the PMSs, and the ULIPs. Right? The ULIPs have the ability to pay much higher upfront.
Okay.
And then the AIFs which can pay higher. So HNIs and can go into AIFs and the PMSs, and whereas the distributor might decide that the lower end customers, they might shift into ULIPs. Okay. So that's where the challenge would be for the mutual fund industry, that if they are trying to pass on everything to the distributor, there are competitive products which might provide a trade-off to the distributor.
So Santosh, basically there will be no doubt some impact on the profits of the AMCs. No doubt they will pass it on. How much do you anticipate? The markets doesn't like it. HDFC is down some 8%. Reliance Nippon is down some 8%. The market doesn't seem to be liking it. Your assessment on the impact on the bottom line?
If you look at the PBT, how much PBT excluding investment income these guys are making, around 22, 23 basis point excluding investment income. Even if we are talking about 4 to 5 basis point cut on an overall basis, because we are talking about almost a 15% cut on a 10 to 15% cut on a top line basis. So even if it flows down and you're passing on even 3 to 4 basis point is a cut on the PBT basis, we are talking about almost 15 to 20% cut on earnings.
Okay.
If at all, even if we are talking about 60-70% pass on, we are talking about that sort of cut. So unless and until it is 100% cut and pass on, we are talking about good amount of cuts, because the operating leverage for the top guys is hardly anything. It's all the entire leverage is on the distributor commission. Okay. So it will all depend on how much is passed on. Otherwise, if there is 60% pass on, we might talk about 10-15% cut in the earnings of this company.
Okay. Mr. Subramaniam, is that something that you would see for your fund, a certain the amount of cut that Santosh spoke about? Are you seeing those cuts that could potentially come into your mutual fund also?
Two things here. Like I said, in our case, in the previous also, we passed on the entire cut to the distributors because we are in a very high operating leverage industry and we just can't afford to absorb these cuts. So, like I said, AMC, DMC, they have to take this call. But where I see this benefiting us is that we don't have any schemes above 10,000 crores in size. Our largest scheme is about 6,000 crores in size, and we have a number of very good performing schemes in the 1,000 to 3,000 crore size. So for us, we see this as an opportunity that with a good performance and with not that much impact in TER as the larger funds, we see a good opportunity for good inflows coming in, because distributors ultimately act on behalf of their investors and will choose the best performing schemes. And if they're able to get slightly better commission in it, why not? So I think that this will see a more level. See, SEBI, this part of it, Mr. Tyagi mentioned when he did the AMFI, we had the annual summit of wealth management of AMFI, where Mr. Tyagi mentioned that there is a over concentration in the top 10, top 5 AMCs, and he needs to see a more level playing field. So this is something which would definitely help mid-size AMCs like us, because we have a number of very good performing products in the mid-size of category, which is between 500 to say 2,000, 3,000 crores. And this performance would now get its due merit from the market, we believe. So I think in that sense, it's good from that perspective for our company.
Sir, the full trail commission that the SEBI has mentioned, while obviously it would lead to lower distributor churn, it would probably give lack of an upper hand to larger distributors who want that upfront fee payment. But with my conversations with distributors, they said that there's a slight amount of a marketing fee which they get over and above the regular payment that they are made for large clients and large chunks of money that they get into the EMC. So all of that gets wiped out. Any additional fee on top gets wiped out. So, it looks like the attractiveness for them has gone down sharply. So in light of that, the fund shifting, we had Santosh also highlight, for HNIs into PMS and for the lower ticket clients into a ULIP, does that pose a significant threat?
Absolutely. Because the banks who are a big part of the distribution community, they are entirely operating on an upfront model because their relationship managers need to be incentivized within the very same year for the business they do. Now, in a trail commission, the company earns the money over a longer period of time, but RMs don't look at themselves as serving 5 years, 10 years with the company, and their reward recognition programs will have to undergo a change now. And so the banks will respond in multiple ways. First, yes, there is a ULIP which has an equity allocation in it where they get upfront commission. So what Santosh said, that there will be a shift, not just in small retail investors. I see even in larger high ticket investors, banks who are serving them, they will be tempted to sell more insurance-based products to them. So this is a difference between two regulators. One regulator is allowing upfronts, another is not. So that's something for a larger, SEBI and IRDA to talk together and see how one industry doesn't get a competitive edge over the other when basically the product structure is very same in the case of ULIPs. The second aspect is PMS and AIF. Already this shift has been happening over the last 1 year. If you see, there's been a phenomenal growth in AIF and PMS assets already in the banking and other bigger distributor space. That will get further strengthened with this flow. But at the same time, right, those investors, HNI investors who are not comfortable with AIF because they are high risk, high reward products, they, would demand mutual fund schemes from the banks, and the banks will have to take a call in two ways. One, either they look at, if they want to look at it from a upfronting commission, right? They can internally upfront their revenue credit to the RM from their own balance sheet. Now, this depends on the banks. So they will get the income from the AMC on a trail basis over a period of time. But the banks can take a calculated call and say, I will reward my RMs because customer demand. You can't just treat the customer saying everything will go into ULIP or everything into PMS. There are moderate risk reward people who are not comfortable with the AIF. So they will necessarily have to service them. So banks will have to work out a model by which they incentivize their RMs appropriately from their own revenue stream because AMCs can't give them upfront anymore. That's one thing. The other thing is in terms of the HNI investors themselves behaving this way is that today, banks will naturally do the same thing that I talked about IFAs. They will also look at the smaller schemes in the industry and to see if their performance is up to speed with the larger schemes, but they're getting a slightly better commission. There would be this shift in terms of now looking at a much wider basket. So a bank which was earlier selling only, let's say, 3 large cap funds would widen the basket to 5 or 7 so that they have a different set of schemes from which they can earn slightly better revenue. So I think the dynamics of the industry are going to change. It will take a bit of time for the industry to absorb this reaction, but in about 3 to 6 months, it will settle down. And I see that the distribution of sales by distributors among AMCs will now see a much wider basket than concentrating into a few performing or large size schemes which have good brand recall with the customer. So overall, I would say that this is creating a better level playing field from that perspective.
Okay, Santosh,
within the industry.
Okay, just hold on, Mr. Subramanium. Santosh, do you all have coverage on HDFC, AMC or Reliance Nippon as such?
We cover Reliance Nippon.
So how does it, let's get to specifics. So both of them have corrected significantly. How does it affect these companies? Have you come out with EPS cuts on any of these?
So what we are waiting for to understand that because it's not so simple.
Okay.
The simplest part is that you take the top line and the cut of that to the bottom line.
Okay.
So you're talking about almost 50% cut in earnings.
Okay.
But you can't do that directly because majority of it or a lot of it is going to be passed on to the distributor.
Okay.
So if you do a sensitivity analysis, because ultimately you have to work on a sensitivity level here. Because if you think that 70 to 80% will be passed on to the distributor, you might not be talking about huge cuts, maybe 10-15% cut in earnings.
Okay.
But if you fall below that, maybe if you're talking about 50% pass on or something like that, then suddenly the cut starts to become significant.
Okay.
So that's where it's one part is also wait and watch simply because you have to see that how the distributors react. Because see, simply the easiest part to do is that it's negative for the P&L. It's definitely negative. How much negative will depend on how much it's getting passed on to the distributor and how the distributor reacts to it.
Okay.
Is there an inflow slowdown? if you pass out everything, then there could be a big inflow slowdown in the industry. So how the industry reacts to it, all these things to be looked into picture. But yes, it's definitely negative for the industry.
But most of them have corrected, like even HDFC is corrected significantly. On a pure valuation perspective, are these stocks now attractive? Or do you see more potential?
Yeah, because when they listed, I think HDFC AMC listed with a market cap as a percentage of total AUM at 12.13 versus an RNAM which was at 3.59.
So yeah, so that way RNAM still, even if you think that there could be a cut also, RNAM is still attractively priced. So just if you're talking about it being an AMC, because the problem has been that it has got a discount just because of the ADAG branding which has been and the RCOM issues. But if you forget about that, yes, RCOM is quite attractive even at these valuations.
Any word on HDFC AMC?
So HDFC, see, it was expensive because HDFC, great branding of HDFC as well. So it was expensive for that reason. It has come off quite significantly. I would still say that if there is a 10-15% cut to earnings, it might not look that attractive still.
Okay.
Got that. We'll leave it at that, Santosh. Thanks very much for joining us on the show. And Mr. Subramanium, appreciate you taking out the time and being with us this morning to discuss this crucial event unfolding within the mutual fund space. Well, on that note, we're going to wrap up this edition of Indian Open. Markets not at the high point of the day, but still in the green. Thanks a lot for watching.